When I first started to day trade, it seemed like there were endless indicators, each promising to reveal some exclusive secret about where prices were headed. With so many to choose from, it was overwhelming trying to decide which ones to focus on. I spent hundreds of hours researching different combinations, anxiously tweaking settings on different backtests, hoping to find the one. It took me many years and painful lessons to realize indicators are tools meant to be blended together as part of a comprehensive strategy. I'm now mostly a price action trader, but when I need some clarity or confirmation, I don't hesitate adding a few indicators to confirm my bias. Let me explain why adding a few indicators might help you. Many seasoned traders, like me, rely on years of experience. We've spent years studying and watching the markets. But for beginners, it's a whole different story. When you first look at those charts, it's like trying to make sense of a messy puzzle. When prices swing up and down rapidly, it can be super confusing if you don't know what you're looking for. And that's where indicators come into play. They take all that random data and turn it into clear signals. For beginners, this is very helpful. Take for instance the 50-period simple moving average, an extremely basic yet highly effective tool. This line makes it crystal clear when the market is going up or going down. Even for experienced traders, this indicator can add value. Me personally, I've moved away from indicators for a couple of years, and last month I met a fellow trader that, to my surprise, abandoned his price action approach and started using indicators. You know, many traders actually do better when they follow well-defined rules, taking emotions out of the equation. He told me he worked for 1 year as a quant trader, and they use indicators to build strategies that mix clear rules with computer-generated code. Instead of making decisions based on how they feel about the trade, quant traders use formulas analyzed by computers to give them trading signals. And at that time, I had quite a bad trading period with pretty bad results, and it made me question my previous choices. I've moved away from indicators, and yet there are successful traders that use them. After all, signals from indicators create a step-by-step process that traders can follow without any personal biases. They give you clear rules to follow, so you're not just relying on your discretion. Of course, there's no magical indicator that is right all the time. Most indicators are designed for a specific job. I've grouped them into 6 main groups based on what they tell you about the price. Trend indicators help you figure out which way the price is generally moving, showing the general trend direction by smoothing out price noise. Momentum indicators, which give you a heads up when the trend is losing steam and the reversal might be around the corner. Volatility indicators are your risk meters. They tell you when the market is getting crazy and prices might swing wildly. Volume indicators show you how many people are buying and selling. Price action indicators, which are highlighting certain aspects related to price. And smart money indicators, which provide insight into the actions of large institutional traders. Now here's the thing. Indicators are like rear-view mirrors in a car. They don't predict the future. They tell you what's already happened on the road. There's a delay between when the market does something and when the indicator sees it. Because of that delay, with lagging indicators, you might see a move starting to happen before the indicator shows you. And this can be frustrating if you really want the tightest entries. And that's why leading indicators are my favorite, because they try to predict what the market is going to do in the future. It's like they give you a heads up so you can get into a trade before everyone else. So leading indicators are supposed to tell you what the market will do in the future, while lagging indicators just confirm what already happened. Leading ones react to price changes really quickly since they are trying to predict the next move. That can be good for short-term day traders who want to jump in early, but it also means this type of indicators give false signals since predicting the future is hard. Lagging indicators are a lot slower to react to the market moves, so they're not as good at helping you get in at the very start of a trend, but they tend to be more accurate over time, since they aren't really guessing, just confirming what already happened. Some people see that confirmation as very important, even if you miss the absolute lowest or highest price entry. Others feel like waiting for the confirmation makes you late to the party. It really depends on your style. In the end, both have pros and cons, and that's why combining different types of indicators together gives you the best picture of what's going on in the market. So to get a full picture, it's smart to use indicators from different classes. Here's what I recommend. So trend indicators help identify the general trend direction by smoothing out price noise using mathematical filters. Best ones are VWAP, the 50 and the 200 period moving averages. I like to use a 10 period simple moving average on the daily chart, or the weekly and even monthly VWAP on the lower ones as my primary measure of bull and bear markets. These simple tools will serve you very well in identifying major trend changes. If trend indicators signal the general bias, momentum evaluates when prices may be overextended or ready for a pullback within that prevailing trend. Momentum begins to diverge from price as positions become over-leveraged. You can safely use the relative strength index, the MACD, and the stochastic, which are classic oscillators monitoring this divergence to anticipate corrections. When price and oscillators are telling different stories, that's when you know momentum might change. Volatility expands as price swings intensify during periods of uncertainty. The average true range is my go-to indicator for monitoring these volatility cycles. Bollinger Bands are also helpful for framing trading ranges. Combined with momentum signals, these tools can highlight low-risk entries around supply or demand areas. You know I'm a big fan of volume. Volume adds the critical context of supply and demand imbalances, pushing prices. Indicators like unbalanced volume and money flow track money flows behind the move. My favorite one is called Volume Spread for VSA, and it tracks the institutional volume. Volume divergences in particular have reliably flagged major trend changes for me over the years. And even though you might be a price action trader and you like your charts being clean, you can still use some indicators to help you better analyze the market. They simply highlight some price action patterns or price action levels. Some support and resistance indicators are useful to identify key levels where the price may stall or reverse. Candlestick indicators can also help you to generate potential signals like pin bars and engulfing bars. And my favorite price action indicator highlights the round numbers on my charts. In the past years, a new type of indicators emerged related to smart money concepts. And these tools offer you a framework for finding order blocks, mitigation blocks, fair value gaps, liquidity concepts, and much more. With them, you can find real-time market structure, premium and discount zones, giving you the ability to set alerts for specific price movements. Now that you understand the core classes of indicators, blending different signals systematically is key. Too many novice traders add random indicators without a clear structure, receiving inconsistent signals. Let me share what I do. My process generally involves identifying daily trend direction with the weekly or the monthly VWAP, analyzing market structure using pivot points or with a smart money concepts indicator, checking volatility levels with the ATR, confirming price action with a volume spread for VSA indicator, and when things are unclear, I scan for momentum changes and divergences using an oscillator, the stochastic. I tend to rely a lot on leading indicators. Pivot points are a good example. Floor traders back in the day used them to calculate potential support and resistance levels for the next day. By plotting those levels out, you can see where the market might react or reverse direction. Fibonacci retracements and extensions also try to anticipate what's next. They show you likely retracement levels for pullbacks or extension levels for continuations. Volume is another leading signal. Big spikes or declines can show you institutional activity and where momentum may be shifting, even before it shows up in the price action. Areas of supply and demand also provide insights into where you might expect reversals or acceptances to potentially happen next, sort of like self-fulfilling prophecy levels. So indicators showing these levels are useful. The key with these types of indicators is they try to map out future price behavior ahead of time, rather than just reacting to what already played out. Of course, predicting future price movements is hard, so lagging tools like the VWAP or the ATR remain important. This layered process allows me to filter out counter trend moves during strong trends or choppy ranges. Signals are only followed if they align across indicators. Now let's be clear, there is no set it and forget it approach. Effective trading demands lifelong learning and flexibility. Indicators and strategies must evolve as the market dynamics change. For example, cryptocurrencies require an ongoing adjustment of indicators due to their hyper-volatile nature. Periodically backtesting and adjusting your system also ensures it keeps pace with shifting markets. I would say indicators alone don't provide an informational edge, but combining them together systematically offers structure for finding high probability trades amongst the noise. So you need to develop a balanced, multi-layered system tailored to your style and risk tolerance. The reality is that trading with indicators is not that easy. There are many challenges I've encountered when combining trading indicators. Overcrowding your charts with too many indicators can cause analysis paralysis and inconsistent signals, so you need to keep it focused. Some indicators work better for certain market conditions and certain markets than others. What is working on stock market may not work on crypto. Most important, it will be difficult to determine the best universal settings to work across different markets and different timeframes. I don't have a magic period for a moving average to work on all markets in all timeframes. A lot of backtesting is required. False signals are inevitable as markets are unpredictable. No system is perfect, so maintaining strict risk controls and not becoming married to signals is key. When signals disagree between indicators and it's not always clear which one to follow or give more weight to, just stay out, don't risk it. Also, indicators can't account for news or other market influences that disrupt even the carefully designed systems. So again, flexibility is needed. Maintenance over time is required as the markets evolve. Indicators may lose relevance if not periodically reevaluated on recent price action. Today you might use the daily VWAP and price might respect it, but the next month you might want to use the weekly one as the market stops respecting the daily one. And always remember that price moves indicators and not the other way around. This is why they always look profitable when you look at them at the left side of the chart when the price action is already unfolded. Now, a lot of traders struggle with finding the right mix of leading and lagging indicators. It's easy to over-rely on one type. If you only use leading indicators, trying to predict the future, you'll probably end up with a lot of whipsaws and fake signals. The market can change its mind very fast. On the other hand, if you only wait for lagging confirmations, there's a good chance you'll be late to the party, since the indicator lags by definition. Scalpers who want to hop in and out quickly usually favor leading tools that flash signals faster, but they pay for it with more losing trades. People looking for absolute confirmation before committing tend to prefer lagging ones, but then they risk holding winners too long or missing entries. The best approach I found is to balance it out by blending several types of indicators across multiple timeframes. Leading ones to anticipate areas, and lagging ones to confirm them. That way, you combine the predictive value of leading indicators with the risk management of lagging confirmations. It's all about tuning your setups to your own style.